Hey, it's Richard with Matthews Wealth Management. I hope everybody had a good 4th of July celebration over the weekend. We're filming this the day after, so I do have a little bit of July input, but I did take some time off to enjoy some camping with the family. But we're going to dive right in. This is asset classes performance in the last month. We're covering the month of June of 2021. The first thing you'll notice here is the value rotation that we've relied on so much since February, and actually back to October of last year, has taken a step backwards. So if you remember, what we saw is a lot of value was taking off from February until recently, and now we're going back into the crazy 2020 mindset where growth is where you put your money, just because basically risk disappears and the only returns are in the growth side. So that's what we've seen in the month of June. It's very different. So there's a reason behind it, and we'll cover all of that. But large value down 1, mid value 3, and small 2.7. You actually have a little bit of bleed over into core for small caps, and you got an 876 on the upside. And so we're just talking about US stocks. So normally you would say stocks are up, bonds are down, and bonds are up, stocks are down, that whole negative correlation thing. But we're seeing that inside of the same size companies in the US. So that's a very strange thing to see, and of course there's a reason behind it. So moving on, let's talk a little bit about international and emerging markets. Basically all of the big developed countries are sabotaging their currency as well, and that's why we're seeing this. And emerging markets are trying desperately to run a good economy, and we're seeing a little bit of a positive gain. So typically we see them go up at different rates or down at different rates. So when they're flipped, that's a little bit of a strange thing as well. And we're seeing a -1 and a positive 20 basis points. Bonds are doing exactly what we were hoping that they would do back in February, which is great. We went heavy on tips and long-term bonds and high yields. We really sold out of a lot of our short-term and intermediate terms that did so well for us last year. So the timing on that was just about perfect. We don't do timing. If you follow modern portfolio theory, timing is not worth worrying about. We do asset allocation with tactical adjustments of 1 to 2% per asset class. So anyway, what we're seeing is a 3.5 on a long-term bonds and 61 basis points on tips. Short terms are down. That kind of plays into the same issue we're seeing here. I'll explain that at the end. Then we get into real estate. It's still going up. That roller coaster is at the top, doing that little clickety thing that makes you a little bit nervous at the top of roller coasters. But we'll see when that pops. I mean, it's going to be whenever these foreclosures and evictions happen. So if you've been brave enough, you've made some great money, 20% year to date on real estate. When do you sell is the question. So oil is taking off, and we actually just got word that OPEC is going to not meet its production goals, so to speak. So that's going to limit supply and send oil up even higher. We're very heavy in commodities, so I'm happy to see that in a way, not for my economy, but for my business and how we manage money. It works. And then on the biggest thing that we've been wrong about is gold. Since I'm up here preaching every month about inflation, you would expect gold and precious metals to be a good hedge against that. And the problem is that those markets aren't super efficient. So down 7%, and that's basically wiped out everything for the year for gold. S&P 500 is up 2.33%. The Dow Jones Moderate, which if you remember is like a 50-50 type portfolio of stocks and bonds, is way behind. It should actually be about double that at 1.1, 1.2 maybe, but the fact that it's only at 0.64 has a lot to do with these values, right, that are just throwing that off because of the losses in large or in big companies. So anyway, let's move over to the quarter. Everything's positive. There's not too much to gain from that, except that these big 876s have obviously played in the last quarter from April to June. But we see international and emerging markets, that's more normal. That's what we're expecting. And that's in the quarter. This has really just started to happen. People, I guess, are pricing in how these currencies are how they're gonna play themselves out over the coming year or two. Let's see, bonds, short terms are flat, tips are great, 3% in 3 months. They're Treasury inflation protected securities, and we went heavy on them, and they're doing great. Long-term bonds up 6.44. That's on par for a 12% return in the year, so that's good to see. High yield's nice and boring because there's no risk in high yield if the Fed's going to buy all the bad stuff. Real estate, same thing, big numbers there. And this makes more sense, the 8.5 versus 4.6. But the big story is in year to date. We talked about value rotation and the fact that we've had a big growth month. We see in the large caps, they're back to the same, right? So we've got a 14, 13, 14, which basically is the same in large cap. These are huge numbers, again, like 2020, but a lot of that's just printed money floating around. Then you got the 22 versus 9.5, or the 28 versus 4. And we still see that value is winning the day in mid and small cap. So we'll keep our February allocation until there's a reason not to, but to see how these things play out is just kind of keeping up, tracking along, but there's nothing to make decisions off of in this data yet. Emerging markets, international, that's good. Tips 1.73, and you can tell I ran out of a marker there, but the 1.73 for year to date, remember we didn't go heavy until February, and there was a pretty sizable loss in January. So our timing, like I said, was right on for what we were trying to do. Intermediate and long-term bonds down for the year, and if you remember what I've said about intermediate and long-term and that flip-flop, that worked out. Same with high yield, real estate 20, oil's up 52%, so that's year to date. That's not COVID crash, because that was a huge return last year we saw in oil. We've got another 52% this year in oil, so when economies get going, that's kind of the lifeblood of what we see. Gold has erased, well, it was flat basically. If it's down 7 and down 7 in 1 month, well, there you go. It just got taken out for the year. S&P's up 15%, and that's pretty respectable on the Dow Jones moderate across the board here. So let's jump into the key topics. And the one thing that's interesting is the global minimum corporate tax rate. The G7 and G20 kind of talked about a 15% minimum. Ireland balked and said, no, we like our 12.5% because it allows us to be competitive, to actually win business, to invest in Ireland, build our GDP, build our tax revenue, help our citizens. But the big countries want everybody to basically not compete with them. So as much as nobody likes monopolies, the big countries want to be a monopoly by having the matched amount and give a baseline for us as the United States to increase our corporate tax rate, because taxes matter all of a sudden, which takes us right into national debt. Does that matter? I mean, if we're printing $20 trillion, why not just print 40 trillion? Why not, quadrillion? Let's just go crazy with it. What's the point, right? Why do we even care about a national debt? Because if we issue debt with a negative interest rate, then we're good forever, right? We can print infinite dollars. What is the problem with that? I'd love to hear somebody actually try to argue that there is nothing wrong with that. But that seems to be what we're doing as a country, as a society. And that brings us to what's really causing all of this. And this was really cool to dive into and see all the details of how this works. But there's a reverse repo facility, and I won't get into all the details. If you're getting this on the newsletter, you can see one of these articles. It'll break it down a little bit for you. But basically, money that the banks don't use as collateral to loan money to make interest gets parked in cash, making 0%, right? So there's another facility at the Federal Reserve where they can take that cash and put it on deposit, and they make no interest. So it was there as kind of a backup, right? Excess capital type thing. It has to do with balance sheet management and certain capital requirements that are required by law. So this is how banks are moving money behind the scenes. Well, the Fed, when they were talking about raising rates, went ahead and raised the reverse repo window rate to 5 basis points. And I believe it was at the end of June, we saw the first $1 trillion flood into that window, which means this money is now going back to the Fed, and the Fed is paying interest by printing it, of course. So it's not a huge rate, but the point is that banks are losing their liquidity, right? So part of what the Fed wants to do is to lubricate the economy by making credit easy and increase money flow and all that good stuff. But they just pulled all the liquidity out of the banks. So banks don't have lending capital reserves at this point, because they want to get that 5 basis points of interest, which is tiny if you're putting $10,000 there. But if you're putting trillions of dollars there, it adds up, right? And that's free money that's just being printed for the banks and making it harder for lending. So that's basically what we're seeing with this big shift, because that's what we did in 2020. 2020 was a crazy year for fiscal purposes and what we put into place to recover from COVID and shut down the economy and stimulate growth. And I don't know, somebody maybe could explain that to me, how that all works, but it doesn't make sense to me. And this seems to be a very obvious move that the Fed messed up on. So we'll see how that pans out. I guess they don't know everything like they say. They have all these tools and everything. I won't go down that rabbit hole. That's a big rant. Currently, we're at 20,370 billion. The month of June, we printed 1.25% more dollars, and year to date, we're up 5%. You know, I count this as inflation. So 1 year, 13.84%, and since January pre-COVID, we've printed roughly a third more dollars in circulation. So that's why prices are going up and will continue to go up, and we'll keep an eye on all of that. But this has a huge impact, as well as liquidity and how money moves behind the scenes, on how these asset classes perform. So we're still in good shape from our February reallocation, rebalance, and we'll just keep going along with the storylines and seeing how money's moving on balance sheets, and try to stay ahead of it if we can. So if you got any questions, feel free to reach out, but we'll see you at the end of July.